The US stock market is often said to return 10% per year on average. This figure appears frequently in financial blogs, online forums, and sometimes even retirement calculators. And to be fair, this 10% figure is real. From 1950 to 2024, the S&P 500 did deliver an average annual return of 10.56%. Likewise, from 1980 to 2025, the S&P 500 also generated average annual returns of around 10.7%. Because of this historical performance, the 10% assumption has now become often used in our financial planning. It influences how much we believe we need to save, how aggressively we need to invest, and whether we can achieve early retirement. But then, given how much of our faith lies on this single number, can we actually trust it? And if not, what will be a more reasonable figure to use when planning for the future? Let's find out in this video. So first things first, when people say the S&P 500 returns 10%, they are usually talking about the average calculated over many years. So it's not like your fixed deposit where you park your money in there for 1 year and ding, you get a 10% return. It's not like that. If you look at the S&P 500 returns over the past 100 years, there were only 7 years where the market actually gave 10% returns. In other years, we might see strong gains of 20% or more, like the 3 back-to-back 20+% return that we have just experienced, while in other years, we might see deep losses. In fact, when you look at the rolling return of the S&P 500 over any 10-year period between 1996 to 2026, you will have experienced an annual return of over 50% a year or a huge drop of 40%. It is only when you extend your holding period to 15 or 20 years that returns start to look closer to the long-term average. This is why people often say that you should invest for the long term, because over shorter periods of 3, 5 or even 10 years, there's still a real chance of ending up with little to no return or even a loss. 恭喜发财! If you sign up to Longbridge today, you get a sure win rate packet worth up to 888 SGD with no deposit required. And if you do decide to deposit, you can also enjoy a 5% interest booster on your first $2,000 for 365 days when you deposit $2,000. On top of that, the more you deposit, the more rewards you unlock, with up to $1,370 worth of total rewards. Longbridge lets you invest in the Singapore, Hong Kong and US stock markets with $0 commission and some of the lowest fees around. And for options traders, Longbridge has recently rolled out pre-market US options trading. During extended hours, it is 0 commission, and even during regular hours, the platform fee is just 50 cents per contract with no commission. So if you have been thinking of trying out a new broker and enjoy some sweet deals, you can sign up using my link down below. But then, even that 10% figure is only part of the story. That's because this return is usually quoted in nominal terms. In simple words, this return does not account for inflation. Take for example, if you have gotten a 10% return this year but experienced 3% inflation, your real increase in wealth is only about 7%. In the early 1970s, the S&P 500 actually delivered positive 10-year annualized nominal returns. On paper, investors appeared to be making money, but in reality, the inflation during that period was extremely high. So once you adjusted for rising prices, the real return over those 10 years would turn negative. This means that while investors ended up making money, those dollars were worth less due to inflation. Here's something interesting. From 1900 to 1950, the S&P 500 delivered an average nominal return of about 7.2%, and after adjusting for inflation, the real return was closer to 4.7%. Then from 1950 to 2025, nominal returns were much stronger, and real returns improved to around 7.6%. So where did these higher returns come from? In a paper titled The Equity Premium, the researchers argued that the high average return for 1951 to 2000 is due to a decline in discount rates that produces a large unexpected capital gain. What is discount rates? Can eat one nah? To put it simply, the discount rate is just the return investors demand for taking risks. It is the minimum return that makes them comfortable holding stocks instead of safer assets such as government bonds. So, for example, if a company earns $10 a year and investors want a 10% return, they will only pay about $100 for it. But if investors feel confident about the company and is willing to accept a 5% return, they would now be willing to pay $200 for the same $10 of earnings. In this example, the company did not suddenly double its profits, but rather the price doubled because the required return fell. This is the discount rate, and you can see it in this graph. What this graph shows is the breakdown of the 10-year annualized stock returns from 1900 to 2020 into 4 components: the earnings growth in blue, dividend yield in brown, PE increase in green, and PE decrease in red. What you will notice is that after the 1950s, and especially after the 1980s, there were a lot of green bars. Those green bars represent increases in PE ratios, which means valuations were rising. So what caused this was that during this period, inflation began to fall from the very high levels seen in the 1970s, and the US economy started to become more predictable and resilient. And as the macroeconomic stability improved, investors also started becoming more confident about the future. As a result, they started requiring a lower return to compensate for their risk. This led to the discount rate falling, which led to higher PE ratios, which in turn boosted the overall return of the stock market. Interesting side note, this was also the key reason as to why several markets outperformed the US in 2025. That year, while the US market returned about 17.9%, the Hang Seng Index returned close to 30%, and Japan returned around 26%. At first glance, it might seem like companies in Hong Kong and Japan suddenly experienced explosive earnings growth. But when you break down the components of the return, that was not the main driver. In fact, earnings growth and dividends in those markets contributed less to total returns compared to the US market. Instead, the bulk of the outperformance came from multiple expansion, where investors were suddenly willing to pay higher PE ratios for those markets. So what happened was that prior to 2025, both Hong Kong and Japan markets had been trading at relatively low valuations. But when macro conditions stabilized and confidence improved, investors started becoming more comfortable owning these markets. That shift in perception pushed the prices higher, even though the earnings were not particularly strong. And that re-rating alone was enough to drive impressive returns. But this also raises an important point. When valuations are low, future returns tend to be higher, and valuations are already high, future returns tend to be lower. And that's exactly what's happening right now. Right now, the forward PE ratio of the S&P 500 is rather high by historical standards. And if history is any guide, high starting valuations would often be followed by lower future 10-year annualized returns. Now, don't get me wrong, I'm not saying that the market will crash tomorrow. High valuations have very little predictive power over short-term returns. For all we know, the market can continue rising for years, even when valuations look stretched. However, over longer horizons, such as 5 to 10 years, valuation levels have shown to have a stronger relationship with subsequent returns. Which then leads us back to the original question. If the 10% return is not guaranteed, what is a more reasonable figure to use when planning for the future? According to several analysts, the future returns are gloomy. They are now forecasting that the S&P 500 to return anywhere between 4% to 7% annualized returns over the next 10 years. With the reason being that the S&P 500 have a high valuation now, and those massive gains that we have seen in the past are unlikely to repeat at the same scale. And that is before adjusting for inflation. If inflation averages around 2.4% over the next 10 years, a 6% nominal return will translate into a real return of roughly 3.6%. That is significantly lower than the 7% real return that investors have become used to in the second half of the 20th century. At this point, you might wonder, why am I showing you all this? I guess the message that I want to share is that if you invest for the long term, the returns are still not guaranteed. When the market has been performing well for many years, it is easy to feel smart. But one of the most underappreciated factors when it comes to investing is luck. If you had begun investing in the 1920s, 1940s, 1970s, or even in the early 2000s, your experience would have been very different. In these periods, you have endured long stretches where even after holding for 10 years, your returns would have been close to zero or even negative. Not only that, after the 2008 financial crisis, it was also far from obvious that the US market was about to enter into one of the longest and strongest bull run in history. The United States has been extremely lucky as it has avoided the kinds of catastrophic events that have damaged other markets. Countries such as Germany, Japan, Russia, and many others that experienced wars, revolutions, hyperinflation or stagnation that wipe out investors' wealth. The US, despite recessions and crises, have somehow always managed to avoid those worst-case outcomes. And over time, investors learn to view the US markets as relatively stable and resilient. That growing confidence has then pushed down discount rates and supported higher valuations. But imagine going back to 1900. At that time, the United Kingdom had the largest and most dominant stock market in the world. If you ask then which country's stock market would dominate the next century, which one would you choose? Well, you could either spread your bets across many markets, or you can go all in on the one that you believe will win. If you choose correctly, you will look brilliant. But if you choose wrongly, the loss could be catastrophic. What this means is that if you are banking your entire retirement on just one market, you are taking on very high concentration risk. And that can be dangerous, as history has repeatedly shown that no country's dominance is guaranteed forever. But more importantly, instead of blindly assuming a 10% return in your financial plan, you should stress test your assumptions. For example, what happens if your average returns 4 to 6%? Is your retirement still secure? What if they fall to 4%? Or what if you experience a lost decade early in retirement, just when you need your portfolio the most? In short, investing is not about putting your money in, pray, and hope for the best. Instead, it is about preparing for uncertainty. While you cannot control the returns that the market gives you, you can control your savings rates, what you invest in, how well you diversify, how much cost you pay, and the expectations you set. Because in the end, successful investing is not about predicting the next bull run. It is about staying in the game long enough for compounding to work.